Hi everyone. So we would like to know as what is the basis for certain types of assets. We have done basis for gifted property, basis for inherited property. Today we will be taking up the basis for a personally used asset when it is used for business purpose. Let me repeat, basis for property converted from personal use to business use. So by and large, it takes the same shape as that of gifted property. So here, before we could just deal with the discussion, let me tell you in a very simple terms that here the basis will carry two meanings. What are the two meanings? Basis for the purpose of depreciation and basis for the purpose of computing gain or loss. So as you all know that a businessman can use his personal laptop for business purpose, and similarly, the car that he had used for his personal use, personal life, he is putting it into business use. So if that be the case, quite naturally, you would find depreciation or the asset would have been depreciated during the tenure of using it as a personal asset. And upon getting converted, so we need to know as whether adjusted basis could be the base for computing depreciation. Here is a place where we are expected to that is compare it with fair market value. That is what you have. So before we could just proceed, let me tell you that basis here where we have two different stages. Basis for the purpose of computing depreciation after conversion, and there is on the date of conversion, and the other one for the purpose of finding out gain or loss. As you all know, the business use for which a personally used asset is taken up, and before it is being sold, firstly they would have charged depreciation, and then at a point of time the taxpayer might think about selling it off. So therefore there will be two different purposes that we would be that we would be serving. One, depreciation purpose, the other one gain or loss purposes. Okay, see, now let us just go through what is just stated. When property is converted from personal use to business use, the basis for depreciation is determined similarly to that of the gifted property. So there we know that adjusted basis or fair market value, whichever is lower, same thing. The basis for depreciation purposes is the lesser of the original cost adjusted for improvement or the depreciation or the fair market value on the date of conversion. Whichever is lower is what we are expected to take up. So the first part is over. This is for the purpose of I would say this is for the purpose of finding out depreciation, right? Then we do have the basis not being the same for the purpose of computing gain or loss. So here is a place where you need to be a little more careful. So here we say for gain or loss purposes, the basis depends upon whether the property is sold at gain or loss. So it might cause confusion. For gain loss purposes, firstly we should find out as whether it is sold for gain or loss. Yes. So at this stage, let me tell you that for the purpose of finding out what is the appropriate base, firstly we should check up as whether we end up with gain or loss. So if it were to be a gain or loss, so normally in accounting what we expect to do is we will take up firstly original cost, correct? Then we deduct towards depreciation till it is converted into business property. So I would put it that as depreciation number 1 minus depreciation number 2. What is this depreciation 2? This is post conversion depreciation. So once the personally used asset, when it is taken up as business asset, so quite naturally there will always be another phase of charge of depreciation that you have. So depreciation 2 is post conversion depreciation. Depreciation 1 is prior to that. So this is going to be the base. Okay, this has got to be compared with the selling price. This has got to be compared with the selling price. So original cost minus depreciation 1 minus depreciation 2 minus selling price, if it results in gain, where selling price is greater than the adjusted basis. For this, we do have a basis. If it results in loss, where the selling price is less than adjusted basis as we have computed, the basis is different basis. Different basis. Now, let us know about what is the basis when we end up with gain. Please understand, when you end up with gain, the basis will be original cost minus depreciation 1 minus depreciation 2. That is, adjusted basis will be the basis. What do you mean by adjusted basis? Original cost minus depreciation 1, that is prior to conversion, minus depreciation 2, that is post conversion depreciation. That becomes the adjusted basis. So therefore, the gain that we have computed here is going to be the final gain. Is that clear? I hope you would be clear when we solve through some examples. So until we complete this session, you need to wait. Next, if it were to be loss, that is in this initial computation, or you can put this computation as test 1. If you end up with loss, then the basis will not be the same. Then what is that basis? So here is a place where you got to have a base on the date of conversion, that being adjusted basis on the date of conversion, or fair market value, whichever is lower, minus the depreciation that we have taken up post conversion. This is going to be the basis. Let me repeat. When we hit loss in test number 1, for the purpose of finding out the gain or loss, loss in ultimate computation, the basis will be adjusted basis on the date of conversion, or fair market value on the date of conversion, whichever is lower, minus the post conversion depreciation, that is depreciation 2. That is what we have got to deduct. So that becomes the basis, and that has got to be compared with the selling price, and that difference is what we are going to take it up as loss. So let me repeat once again. The basis has got two different purposes. One for depreciation purpose, the other one for gain or loss computation purposes. Always understand that when personally used asset, when it is to be taken up for business purpose, it is to be taken only for the purpose of using it in the asset. So thereby your depreciation is imminent, that is unavoidable. For that purpose, it is to be taken up as adjusted basis till the date of conversion, or fair market value on the date of conversion, whichever is lower. So that figure is going to be the basis for the depreciation to be charged after conversion. Okay. Second one. What is the second one that we have? The basis for the purpose of finding out gain or loss. So here is a place where we have test number 1. Firstly, we are going to find out as whether we end up with gain or loss, as we normally do in the case of accounting. I mean in financial accounting. How is that we will arrive at? Gain or loss is, firstly we will arrive at the adjusted basis, which is nothing but the original cost minus the depreciation 1, that is depreciation prior to conversion minus depreciation 2 post conversion. So you will get a adjusted basis on the date of sale. That has got to be compared with selling price. When selling price is greater than the adjusted basis on the date of sale, it is becoming a gain, and whatever basis that we have used for that purpose, that becomes a basis. So therefore, the gain that we have computed initially and the gain that we will ultimately be communicating will be one and the same, right? Let us just take up a scenario of loss. So here on the same basis or on the same note, when we are computing the basis on the date of sale, it is going to be original cost minus depreciation 1 minus depreciation 2. This is going to be what? An adjusted basis on the date of sale upon comparing it with selling price, where selling price is lower than this, it is going to be a loss. If loss is identified in test number 1, then the basis for this asset will not be adjusted basis, where we have got to bring out a comparison. What is that? Adjusted basis on the date of conversion, and the fair market value on the date of conversion, whichever is lower. On to that, we are expected to deduct towards post conversion depreciation, and that figure is going to be the adjusted basis. That has got to be compared with the selling price, and that would result in loss. So that loss and the initial loss need not necessarily be the same. So in some cases it will be same, in other cases it will be different. Is that clear? So we will better understand it through some examples, which we will take it up in the next slide. See now, for the purpose of depreciation, so it is conveyed that basis for depreciation is a lesser of the original cost and adjusted for depreciation. In fact, they have mentioned it as improvement. So quite naturally, it is for depreciation alone or the fair market value on the date of conversion. Then number 2, for gain loss purposes, the same thing is repeated here. Now we will proceed to the next slide. So just to make the matter clearer, we have just added one more slide to see that what is the basis for depreciation purposes. Original cost when it is A, depreciation till the date of conversion DOC is B, and adjusted basis as on the date of conversion C, that is A minus B. Fair market value on the date of conversion, which is D, and basis for depreciation is E, which is nothing but C or D, whichever is lower or whichever is lesser. Now let us just take up this particular slide to drive home the point for finding out the gain or loss ultimately. So now let us just have an asset column. Then we shall have original cost. Then we shall have depreciation number 1, which is nothing but the depreciation till the date of conversion. Then you can put it out as adjusted basis. This has got to be compared with the fair market value when there is a necessity where it is loss at the initial test. Then comes depreciation 2, then comes sale value, and ultimately we shall find out as what is the gain and the loss. Correct? See now let us just take up asset EA. I'm just not putting it out as Jeep, car, truck and all that. I say I'm just putting it out as EA. So let us just know about what is that. The original cost is $15,000, and the depreciation in the very first place is let us take it up as 3,000, and adjusted basis is going to be 12,000, and let us assume a fair market value for this being 11,500, and post conversion depreciation is 1,000, and sale value, let us assume it as 9,000. So now in case of test number 1, that when we take it up, so we understand that it is 15,000 minus 3,000 minus 1,000. So adjusted basis on the date of sale is 11,000. This has got to be compared with 9,000, which results in loss. So this is test number 1. Then this is resulting in loss. How we would find out ultimate loss? So that comes through test number 2. So what is the basis? So we have 15,000 same minus same 3,000. So now it becomes 12,000. 12,000 versus fair market value 11,500, whichever is lower, 11,500 minus post conversion depreciation of 1,000. Now it is going to be what? It is going to be 10,500. 10,500 is to be compared with 9,000, and thereby ultimately the loss is booked at 1,500 and not 2,000. So it may be 2,000 initially because of the difference between the adjusted basis and fair market value. That amount of change is also impacted in the ultimate loss. Is that clear? So this is the point that you have, and now let us just I think you people have observed this matter, right? So I would like to take up for the purpose of gain through another example. So this computational space we have just got it, and now let me take up for the purpose of gain. So this is asset B, and it is $20,000, and this being $2,000, and adjusted basis being 18,000, and it is 21,000 as a fair market value. Post depreciation is 1,250, and the sale value is 24,000. So if this be the case, how is that we will arrive at the basis and the gain? Say now let us just take up this into two areas. Test number one. Initially we will arrive at the test. Test number one, 20,000 minus 2,000 minus 1,250. So 3,250. So where you get 16,750 versus 24,000, this results in gain. Correct. In test 2, the base is going to be the same. So 16,750 minus 24,000, this would result in 7,250 gain. So in the earlier one I forgotten 1,500. I hope things are clear for you, as the gain, the test 1 gain and the test 2 gain will be same. The first stage and the second stage will give you the same result. Now let us just try two more, then we can understand as how it operates. See, in this case it is 24,000 and 1,700, and adjusted basis is 22,300, and a fair market value is 20,000, and a post depreciation is 1,810, and the sale value booked is 17,150. Say I just noted down in my paper, and I would like to just use the data for the purpose of explaining it here. See, all of you closely follow. So test 1. So whether it is resulting in gain or loss, firstly we will find out. So 24,000 original cost minus 1,700 first level of depreciation minus 1,810 the second level of depreciation. So that has got to be compared with the sale value of 17,150. Now let us just do that. So it is 24,000 minus 1,700 minus 1,810. That gives you 20,490. Let me just check up once again. It is 24,000 minus 1,700 minus 1,810, 20,490. This is compared with 17,150. So this results in loss. Okay, when it results in loss, ultimate loss as how it has to be computed through test 2. So where adjusted basis on this date being 20,490 versus 20,000, the fair market value on that date, whichever is lower. That means 20,000 only I should take up minus 1810. So 20,000 minus 1810, when I deduct, what I end up is 18,190 versus 17,150 minus 17,150. This results in 1040 loss. So the initial loss that we have initially taken up 2490 minus 17150, which resulted in 3340 loss, whereas loss is not 3340 and it is simply 1040. So people might ask this question, gain is retained whereas loss is reduced. See, it's quite natural to understand that any government for that matter, whether it is an Indian government or a US government, whether it is an income tax department or IRS, say they would like to not touch with the gain because gain will not be reduced. If it is reduced, taxation will get reduced. So therefore, they will not touch or they will not do any activity to reduce the gain, whereas they will try to reduce the loss. So when there is a loss, whether it is a higher amount of loss, 3340 or 1040, what is a great deal is what people might just ask. Please understand that loss, when it is allowed, it has got to be adjusted in the future, and the future gain will get affected, and thereby the revenue for the governments will get affected. So therefore, the logic is a very simple logic only. Now let us just take up when the initial loss and the ultimate loss turning out to be the same. So now let me just take up an example. 40,000 here and 6,000 as the depreciation there and 34,000 as adjusted basis here, and the fair market value is 38,000 on depreciation 2 is 2170 and ultimate sale value is 29,000. See, now let's just try test 1 and test 2. Test 1, where it is 40,000 minus 6,000 minus 2170. So how much it comes to? 40,000 minus 6,000 minus 2170. Ultimately it comes to 31,830 versus 17,150. It results in loss. How much is the loss it results to? This is versus 29,000. Extremely sorry. The loss is to the extent of 2830. Right. Test 2. So you get 31,830 adjusted basis on the rate of conversion versus the fair market value of 38,000. So that be the case. Not this 34,000 versus 38,000, whichever is lower. 34,000 we will take up. Minus 2170, so you will end up with 31,830 versus 29,000. You end up with same loss of 2830. So please understand, so the crucial aspect in all these cases, we're all done with the help of this fair market value. Where it is greater or lower, that will decide upon the entire thing. I hope things are very clear for you. So before we could conclude, let me tell you that basis for which there are two things that you have. Basis for the purpose of depreciation, basis for the purpose of computing gain and the loss. Okay. So with that, we are just putting an end. With that, we are putting an end for this particular discussion. I hope that you enjoyed this discussion. Thank you.